Now let's say right here, this is a zero line with your money. What most people do is they go in and they buy an item. Let's say a car. And they buy this car by going into debt. And over the course of 5 years, they're paying for this car, trying to get back to zero. And then when they're ready for the next purchase, let's just say they're buying the wedding. It's the wedding time for their kids. They go back into debt and they have to work their way right back up to zero. And then now they got that all paid up and now it's time to go back into debt because I want a boat. I want to go get a boat. Let's go get a boat. And they go all the way back to zero, right? We call these people debtors. We're always paying interest because we don't have working capital for us and we can't save. Like we can't save. And we're the type of people that just work to spend. We're always fighting just to get back to zero. We, the people, have decided to pledge a future portion of our check to other people. At this point, we are somebody's asset. And that somebody is called the bank. We are the bank's asset. And the crazy thing about it is the banks would kill for us to not know how to break out of this because it makes them buku money. Now, you must say, Justin, you don't know me. I pay cash for everything. Guess what? I'm going to show you that you still finance everything that you buy, even though you pay cash for it. And that still doesn't make you any better than a debtor. Growing up, our parents told us to save money so we can buy nice things, or at least have enough money to buy nice things. Let's say it's just for a car. But here's the problem. We save up our money for 3 to 5 years, and it's that time where we're able to buy a real nice car. But at the same time, after 3 to 5 years, we can also be in a position where we are growing a nice compounding interest curve. And of course, instead of giving up the nice compounding interest curve, what do? We ended up draining our bank to pay for this car, and now we're all the way back to zero. Then of course, the next expense comes, kids' wedding. We save up to have enough money for the kids' wedding, and then when the wedding comes, boom, we're back to zero. And every time we think we're saving money and doing it the right way to buy a big purchase, we always end up draining our banks and ending back up at zero. Why is that? And it really doesn't even matter if we're paying interest or not, because even the debtors are fighting their way back to zero. Now, when it comes to being a strategy saver, there's one thing that we're forgetting. Opportunity cost. This means if we're a debtor or a saver, we're missing out on a tremendous amount of opportunity cost in these two ways. Number one, if you're saving money in the bank and the bank is gaining a 0.01% return on your money, you're already losing right there. That's opportunity cost. The crazy thing about it is when our compounding interest wants to skyrocket, we decided to deplete our whole bank account just because we're great savers. Not only that, but that money leaves our personal economy, and let's say we go buy a boat and it goes to their economy for them to flow the money through, if not lend that money to someone else. We gave them our compounding curve. This is how some banks and institutions and even car dealerships get wealthy. Wealthy saves their money to the point where they will need to make a purchase like a car. The average person will drain their tank or their bank and try to fight back to zero. Wealthy people don't do that. Wealthy people understand that they're getting super close to gaining compound interest and getting massive growth. So what do? Instead of spending cash, they actually borrow against appreciating assets and go ahead and pay it back and let it flow through their personal economy again. And because they're borrowing, at the same time, they're paying back their assets each and every year. And it just keeps getting better and better, whether it's your car, a wedding, investments, real estate. You can even invest in your business or even purchase a new business. This is how the wealthy gets wealthy. Just like Arthur of Rich Dad Poor Dad, Robert Kywosoki says, there's a difference between the wealthy, the rich, and the middle class, which is debt and taxes. So in this example here, they're taking their money out, which is called borrowing. And since it is borrowing considerably, it's income tax free. This is the power of using other people's money. The second key point here, which I think is probably the most important one, is they're never interrupting the power of the compounding interest. Now, there's only one financial vehicle that can do this, and I like to call it the Smith Fund, or most know it as the Max Funded Tax Advantage Life Insurance Contract. Now, keep in mind, although this is an insurance product, the focus is not on the insurance. The focus is on taking back control of your life, eliminating taxes, eliminating interest from banks, and also the opportunity costs coming back in your favor. Have you ever considered being your own bank or even taking back control of that banking function in your life? Get rid of the middleman. In the link below, my team and I have created a free ebook for you where it teaches you how to become your own banker while also mitigating the risk and taxes. My name is Justin Smith. This is the Investments YouTube channel, and we'll see you next video. Peace.